Hey, what is going on, guys? Edward here, back with another video. Thank you so much for being here again. So this opportunity, I want to talk about the mean threshold and consequent encroachment. Encroachment. This is one of the things that is actually very difficult and sometimes overwhelming, from ICT techniques. And this is the things that, of course, that confuse a lot of people is the actual wording, right? All this terminology and these words and this wording, these weird words that are used in this type of techniques confuses, right? A lot of traders. So anyways, I'm going to show you what it is, how to trade it, and just make it as simple as possible. I'm going to show you, as a matter of fact, just a little clip on top right now, here on top of the screen, a clip directly from ICT himself, telling you right away what it is, and then I'm just going to give you a couple of examples. So let's see what it is.
Watch the top of this candle here, and here, and in the middle of that is mean threshold. Half of an order block, whether it be a breaker, mitigation block, or just a standard order block, midpoint of that is mean threshold. Any gap or any wick, like this wick down here, half of that is consequent encroachment. So consequent encroachment is the midpoint of a inefficiency and or gap. Very, very sensitive price points in price action.
There you go. So basically, a mean threshold and consequent encroachment just basically is the midpoint of an order block or a breaker block is the mean threshold. It's just the actual midpoint of an order block or a breaker block. Okay, that's the mean threshold. And the midpoint of an inefficiency, fair value gap or imbalance, it's all the same. You see, you have three words in one single thing, right? So inefficiency, fair value gap, imbalance, it's all the same thing. It should be just one word, but it has three words, so it makes more confusing, right? More overwhelming. So anyways, the midpoint of a fair value gap is the consequent encroachment. Now, how do we approach that? How do we trade that? How can we use it in our favor? Right, so basically this is like refining, I'm sure you have heard about refining an order block or refining a fair value gap. Let me just explain, right? I'm going to go straight to the chart right here. So I'm on the weekly time frame on Nasdaq. I'm just marking up this actual order block. If I wanted to mark up the mean threshold of this order block, right? This is the actual bullish order block, right? So it's the body. Go from the body, from the top of the body to the bottom, right there. That's it. That's the actual mean threshold, right here, the midpoint. Okay, that's simply it, right? So there's two ways. If you want to enter on an order block, you can enter just right there at the very top. As soon as it taps, it goes, right? Or let's say you want to take more profits, okay? Because that's actually what it is. The reason why he created this, or he find out, discovered, whatever, this is because if you're trying to look for a buy, for example, right here, hold on. If you're trying to look for a buy in this order block, you can enter, right, normally on that order block right there, and place the stop loss probably below, right, below the actual swing, just to protect, and then probably targeting this high, right? Now, another type of entry is that instead of entering right there, you go and place your buy limit at the mean threshold. So what is that going to do? It better is to reward. Simple as that. That's all what it is. Now, that's the reason why we use the mean threshold or the consequent encroachment. Now, let me show you more examples, right? Just right here in the same area, but I'm going to go now at lower time. I'm going to go on the daily. And I think that was actually on a 4 hour, and we started to have something right here. So when we have a higher time frame PDO rate, right, that we're just tapping into this order block, right? So ideally, we want to look for a buy formation or a buy setup, right? So let's see what is actually happening right here. We have the last move, price actually swept liquidity from this low right here. That was the last sweep. So sell side liquidity right there. And then where would be our order block if we want to buy? Our order block is actually the opening price of this candle. So this is going to be our order block, right? also known as change in the state of delivery. There you go, another word that makes more complex ICT. Okay? It's the same thing, change the state of delivery, order block, basically the same thing. And where is the market structure shift? Right here. We do have a market structure shift right here. Or chalk, again, another type of word. So there we go, right? So when price breaks, now let's just go here at this point. Let's just go in this area, right? So right here, we do have understanding. Price is tapping into an order block in higher time frame, right? It's my higher time frame PDO rate. Now, when I go 4 hours, I'm just waiting for that break. As soon as this candle closes above, it validates the order block. So I can already be looking for a buy. Automatically, I can place a buy limit order if I wanted to, just right here, right? And my stop loss is going to be below the swing low, below that low, okay? This low is supposed to be protected. Not all the time, but it's supposed to be protected, right? Price apparently has nothing to do below these lows anymore. At least that's what we think, right? So anyways, we're going to be targeting probably highs, or you could be using the Fibonacci, the actual extension, using the projection, right, and targeting anywhere here in between the standard deviation projection. Let's say you want to target just right there, right? So this is if you enter at the order block. But let's say you don't want to enter right there. You actually want to catch the mean threshold, right? So you're going to use the fib. From the high, it's these two candles, okay? It's these two candles right there, the actual order block. It's not this one at the bottom. If you want to refine the order block, a lot of smart money concepts actually they use the last candle, but in reality, is that entire two candle to the downside. The two candles are the actual order block. So the mean threshold of that would be the 50%. So if you want to refine the order block, you'll be placing your buy limit order right here. That's where you're looking the entry, right? At the mean threshold. So what is that doing? Instead of going now for a 1 to 2, now this is looking like a 1 to 5.4 risk to reward. A lot better, right? So let's see what it does. Price goes, tap, you see immediately. Ideally, if you want to trade, the cool thing about this is that, let's say for example, you don't want to place a buy limit already. What you have to do is just look or wait for the price to tap into the mean threshold and look for a reaction. You don't want to see a body of the candle actually closing below the mean threshold. If it closes below, probably it's not a good sign. Okay, that's pretty much what ICT says. So anyways, price taps in and directly goes straight up. Okay, this is where we are at the moment, because this is live. This actually happened today. So yesterday, I'm sorry. So look at what happened, right? Price just tapped into that. Now let's make it more interesting. Now let's go lower time frame. Let's go 15 minute. And now that we know, let's actually go. Let's go here, right? And let's go lower time frame yesterday. So let's try to have fun right here. So take a look. At this point, we are approaching the mean threshold. We're just tapping the 50%, right, of the order block. Just tap the mean threshold right there. So if you are trying to look for a buy, because we were on H4, right? Do you want to buy on higher time frame? You can do it. That's going to be a swing trade. You can go lower time frame, ideally 50 minute, 5 minute, even 1 minute time frame. So at this point right here, we see that we're having, where was the last sweep? Right here. Where would be my order block? Right there. That's going to be my order block. So let's see if we happen to have a closure above that high. If we have it, boom, perfect. We do have a closure above. That means that this order block is validated. Okay, at this point. We do have that sell side liquidity being taken. Very important. We are tapping the midpoint at this point of the mean threshold in H4, right? We're tapping a PDO rate, higher time frame PDO rate. So I'm not just looking for a buy anywhere, right? In the middle of nowhere. No, I have a reason why. Okay? As soon as I tap, you see the reaction. So right here, you can do the same thing. If you want to enter right away, you can either enter right here, place a buy limit order, right? and go for, use your Fibonacci, go from the low to the high, and you simply do this projection and go for a 1 to 2, right? Let's say you want to, or probably you want to target this highs. Ideally, you want to watch out for that 1 to, for this between 2 and 2.5, price tends to reverse sometimes in there. So that's how the entry looks if you enter at the actual order block, just right at the top of the order block. Now, let's say you don't want to enter right there, you actually want to enter at the threshold. So measure from there, from the body of the candle, the top to the bottom of this candle, the body, not the wick, but the body. 50% of that, it would be right here. Let's see if we actually get tapped in. You see, we were looking for, how was this looking? It was looking a 1 to 2.9, almost a 1 to 3, right? But right now, this is being now a 1 to 6 risk to reward. Now, can we get tapped in? Let's see. We did get tapped in. If you see the rejection, right? The rejection was like almost immediate, right? At this point, boom, tapping that 1 to 6 risk to reward. And that's it. Instead of entering it for in the 4-hour time frame, you could catch this nice little 1 to 6, and it would only take just a few hours, just a couple of hours. If you were to enter in 4 hour, you would be holding right now. It's going to be a swing trade, of course, but you see, it's basically the same thing. You see, we're trying to just, the mean threshold is just that, guys. Don't overthink, don't overcomplicate. The mean threshold is just basically a refinement of the order block. Now, the bad thing about this is that if you're looking and you're hoping that the price will all the time tap into the mean threshold, that's never going to happen. It's not going to happen all the time. Okay? You have to understand, yes, you have a better risk to reward, but not all the time the price actually taps into the mean threshold. There's going to be times where the price is just going to react at the actual top of the order block. So you have to understand that sadly, yes, if you are if you're placing your entry right here, you may be left behind. The price is just going to go away without you. That's very possible. Okay. So ideally, sometimes what you can do instead of just entering at the mean threshold, you just mark off the mean threshold. Right? Let's say you were right here again. Right here, right? And you just want to see if the price actually going to react to that. So you see the price is tapping in and rejecting. As soon as you see that rejection, that is actually good. That's what you want to see. So that first rejection is a good sign. So you could actually enter as soon as that candle closes. You could be feeling very confident in taking the shot in there, right? Because it's showing you the rejection at the midpoint already. The candle is failing to close below. Now, you can wait probably for another candle to show you just more volume to the upside, entering probably a little late right there. If you want, you can also take that shot. I mean, it's not bad. If you have some sort of FOMO, right? Or you're feeling scared of the price is coming back down, you just wait for the actual reaction and you have, boom, 2 candles and a pin bar right there, beautiful. And now you get a bullish candle. That's when you could take the shot. But be careful, because sometimes after the reaction right here, the next candle may just skyrocket and you don't want to be taking an entry somewhere here, right? That's just way too late, okay? You kind of want to enter somewhere at least close to the entry right there. So hope it makes sense right there. So this is basically the mean threshold, okay? Now, what is the consequent encroachment? This, again, the mean threshold is the midpoint of an order block or a breaker block. If you also look right here, where is the breaker block? We do have this 2 candles to the upside. This was a bearish order block that got broken with this candle. Once that got broken, I can use my fib from the high to the low of these candles right there, right? And this is the mean threshold of this breaker block. So let me mark it up here. This right here is the actual breaker block. So you can see that the price is also rejecting the mean threshold of the breaker block. Okay? You see, it's just that simple. It's just the midpoint of a breaker block or an order block. Now, the consequent encroachment is the midpoint of a fair value gap. Let's see what sort of entries we can catch with that. Let's see. Now right here, very simple. Look at what just happened right here as well. So we have this sweep, price is taking this highs, and recently also took this high right here, right? So after sweeping, we got a displacement below. Now look at what happened. This is an order block, right? This bullish momentum taking this buy side liquidity right here. Price displaced to the downside. This is my order block, right? My, in this case, bearish order block. So price created that order block. Price comes back in, taps into the order block, and now it starts displacing to the downside. So in this displacement, look at what's happening, okay? Use everything in confluence right here, in conjunction. So we see the price just swept liquidity and now displaced, right? So shifting the structure. We do have market structure shift right here. Now price is tapping the actual order block, and as soon as it taps, you see that if you were looking for the mean threshold of this order block, the market did not reach the mean threshold, right? It just reacted. Look at the reaction immediately. So this is what you can do. You are seeing that the price is already reacting. So when you're right here in this area, this is what you can do. When you know that fair value gap has been formed, when you're bearish, you already saw the shift in the structure, right? Price is shifting. You swept this accumulation. Technically, we had an accumulation right here, and we had manipulation, and now we're looking for that distribution to the downside. So good, we're in a good direction. So what do we have? Well, use the fib from the high right here. This is the fair value gap, right? This is my bearish fair value gap. The price just reacted to this order block and displaced to the downside. So it's leaving the first fair value gap that is living right there, right? So normally, if you wanted to go short right here, you would be entering at the fair value gap, placing the stop above this high, right? Probably going for 1 to 2, whatever, probably a little low, I don't know, right? So you could have entered right there, or look at that, or entering at the actual consequent encroachment, which is the midpoint of the fair value gap. So what does that do? It just simply you're refining your entry now. You're making it smaller to have a much better risk to reward. That's just it. Okay. So consequent encroachment is the midpoint of the fair value gap. If you wanted to continue selling, I don't know how it played out after that, but probably this is Asian session. Yeah, we're going into Asian session right now. So, I'll probably be measuring this now, this fair value gap right here. See what's going to happen there later. But no, at this point, because of the day, I think we might actually be breaking that, and we actually did. Later on, we just broke it with the recent news that we just had. So, hope it makes sense. Another thing you can use is the actual weeks. Let me find you an example right here. Next one is right here on gold. We see that the price just recently swept this high and respected the psychological level, this rounded number. So we sweep liquidity right here and rejected that very strong to the downside. This week is normally an inefficiency. So you can mark up the 50% of that. And if you wanted to go short, okay, you already know that in lower time frame you have that displacement to the downside. So you could be actually taking a short right there at the mean. The consequent encroachment right there, and of that inefficiency, and probably be targeting lows, right? Also, you can also see that the price, in fact, also tapped in. I think it also tapped in the consequent encroachment of this inefficiency right here. It tapped into that 50%, rejected, and automatically you're getting another one being formed right there. So look at what price actually does. Price comes back, taps in, and immediately melts after that. So you see that you can also trade those weeks, those long weeks right there, depending on where you are, what the price is doing, where the price is tapping. And very important to understand, you need to put it into practice, okay? If you look probably in lower time frame, 15 minutes, that's how it looks. It was just a big spike due to some sort of news, fundamentals, price skyrocket, and then price just get back inside of the range that wasn't there. Then price normally pulls back to 50% of this whole impulse, basically, and then crashes from there. So hope it makes sense. Hope this was actually simple, straightforward, straight to the point. you still don't understand, just let me know in the comment section. Give it a big thumbs up. It motivates me to keep posting content for you guys more often. I'll see you guys in the next one. Take it easy.